Just, what are we? We're just about a month away from January 10th. And January 10th, as we know, is the qualified mortgage rule. Its date of birth will come to life on that day for all of us. And I'd love to spend some time with you today because I think you're going to really enjoy the new flavor and the new version of the qualified mortgage rule from where we all understood it earlier this year. And of course, when I was over there at DC with some of our fellow members earlier in the first quarter, and the version of QM and our speaking points have really shown up that people want to listen. They are listening because we're about ready to go a little bit deeper today and learn how the final version is going to show up on January 10th for all of us. But really quick, before I do that, I'd love to just take a brief moment and ask by a show of hands. On your screen there, you have the ability to press your hand button. I'd love to ask by a show of hands, based on the knowledge you have today, how many of you are looking forward and are excited about the new QM rule that's coming on January 10th? I'd love to just take a moment to see a show of hands of who's looking forward to this new QM rule. Just a moment. It's right there on your side screen. For those of you who are looking forward and excited, I'd love to see a show of hands. I see TP's got their hand up, and most of my screen here is showing that most of us are not that excited about this upcoming change. And I've got to share with you again my earlier interpretation and version of this year and the one that we're ending up with now. It's my hope that at the end of this visit today that I see a lot more of these hands go up. With that said, I'd like to go a little bit deeper now and share with you the parts that really pertain to us. And that's where I'm going to focus on today and this morning. And specifically, I'm going to speak about the qualified mortgage rule and the gifts that come within it, specifically the protections for the lender and the borrower once they receive a qualified mortgage. And there are two that we're going to focus on because these are the two that are offered through the ruling. And the first one is dealing with loans that not only fit with the guidelines we're about to review, but they also certify that the fees paid by the borrower are in alignment with the average fees and costs for obtaining a loan, and that the borrowers that receive a safe harbored loan are borrowers that are going to receive a loan which becomes certified as a qualified mortgage and a safe harbored loan, which means that the fees they paid were in alignment with what loans are going for at that market. And we'll go a little deeper in the safe harbor. The other type of protection that comes for the lender is a rebuttable presumption. The difference between both of those is that under a safe harbored loan, that lender is not required to defend a lawsuit brought upon them as it relates to the ability to repay in the qualified mortgage if they wrote to a true safe harbor, which includes the cost associated with the loan. However, there is a protection also available for those lenders that charge higher price loans. This might be for a jumbo loan, where we traditionally see rates offered higher than what we can actually capture on a conforming loan. That doesn't mean that those jumbo lenders won't receive a protection. It just means that they'll get a rebuttable presumption protection, which means they may have to verify that they underwrote to the qualified mortgage and ability to repay rule if they were ever sued, and a consumer could bring a legal action against an ATR with a rebuttable presumption. So those are the two main differences on the ways that lenders and borrowers are going to give and receive a qualified mortgage moving next year on those two formats. And screen 2 here that we're looking at is just going a little bit deeper about what I've just shared with you. It's about saying that on a safe harbored loan, that as long as the premiums and the fees paid for achieving that loan did not exceed 1.5% of the average prime offering rate in the market, then that's a safe harbor loan. And that just protects the lender completely, and the consumer is barred from even attempting to argue a violation of this requirement. And again, what we just said moments ago is the 1.5% becomes our trigger as it's written today. And please keep in mind, as we see the new QM start unfolding, there is going to be opportunity in the future for continued reinterpretation. But for the version that we're going to use in January, 1.5% seems to be that trigger for moving us out of the safe harbor and placing us in a rebuttable presumption. I'm going to now go in and share with you something that really excites me as a broker, and I think most of us on this call have a right to get excited, and that is dealing with one of these updates that the CFPB made this year. One of the things that I feel that are affecting most of us in the industry as brokers and as wholesale lenders are the type of products we get the chance to represent and really get to offer our clients and consumers. Right now, the majority of all of these loans are through government-sponsored entities, Fannie Mae, Freddie Mac. But boy, don't you also miss those days when we had our Alt-A programs and we had really some other interesting and really beneficial loan products to offer to the consumer? And that was because we had an active secondary market. And that active secondary market shut down for the first time in history in August of '07. And ever since its close and collapse, we've all have been forced to go to Uncle Sam to do our banking and to get loans to get processed. And once we have the opportunity for a private secondary market to reopen and get reestablished, then we get to invite other investors and programs to show up on our rate sheets and programs to offer our borrowers. And one of the new tools that live in the qualified mortgage rule is that there is a 3-year statute of limitations that a consumer can bring to a lender that says that you did not verify that I had the ability to repay this debt. Therefore, lender, I am suing you. So for the first time in our history, we have new laws in place that signal private investors to come back into our markets and say, hey, we have tools that now protect you. And as we go further, if you'll underwrite to these other guidelines, we'll give you even further future protection. And I think that as we start seeing this visit go out further, it's really a great chance to really appreciate some of the gifts that live within QM, because it's these gifts that should invite more participation from the private markets. With that said, I'm going to go right now into the requirements that relate to the ability to repay in a qualified mortgage rule. And with this said, there are 3 types of requirements that really relate to a qualified mortgage, and these deal with restrictions on how the loan is offered and the features which live in it. The other requirement deals specifically to the way we underwrite loans, and then it's as specific as it can as it relates to fees and points paid for acquiring a mortgage loan. So these are the 3 main requirements that relate to a qualified mortgage. And we're going to dig just a little bit deeper in a minute, but I want to start first with sharing with you what is not considered a qualified mortgage. So these are loans that are offered today and tomorrow that will not become part of the qualified mortgage rule. With that said, our first one is home equity lines of credit. So all of your HELOCs, whether they're in first, second, third, or fourth position, open lines of credit will not be part of the qualified mortgage rule and are exempt. The reverse mortgage products offered are also exempt from the qualified mortgage rule. Timeshare plans as well as short-term construction loans or short-term temporary loans are also immune by the new QM rule. So those are specific loans that will be outset and carved out of the QM moving forward. Everything other than that is part of QM. So your traditional purchase loans, your fixed rates, your ARMs, those are considered qualified mortgages. And I'd like to start with you and really go into the restrictions. As I shared with you, there's loan features that have to be part of a loan that make it become a qualified mortgage rule. And specifically, there are 4 of them. The first one is that the loan being offered cannot have a negative amortization feature within it. This one's going to be pretty easy for us. We've not seen negative amortization loans since the collapse of the market in '07 and '08. So I think as we continue to look at the things that don't qualify, I think what you're going to start realizing is that these are all the things that we're already doing. It's how we already operate business, and it's what's most familiar for consumers. Because negative amortization is not an easy loan for a consumer to understand. So it's no longer going to be part of a QM offering. The other type of loan that offers confusion to consumers are interest-only loans. So loans, whether they're fixed or adjustable, may no longer offer an interest-only feature to be able to qualify for QM protection. Balloon payments are also no longer accepted for QM participation in terms which exceed 30 years. So as we look at the restrictions, the word restrictions sounds like there's a penalty. It's going to be very tough to deal with. But when we look at the data, it's quite nice. It's no negative amortization, no interest only. The balloon payments, I've not done one of those ever, and terms that don't exceed 30. So very familiar for the consumers and brokers. So no new language and the actual restrictions that relate to the loan types. Now, let's talk about the underwriting changes. So for the first time, we even have laws that relate now to the ability to repay. We have clear direction on how the actual mortgage needs to be underwritten. What specific steps within the underwriting process itself must be familiar and similar in each loan to qualify for a qualified mortgage as it relates to the ability to repay. And you're going to really enjoy this. The first one is dealing with the borrower's expectation of their income and assets. Well, my goodness, you guys, this is what we already do. Isn't it already a requirement that when we review the income, it's the 3 years moving forward that we need to anticipate will be available? In the way that this was originally written, we had to get that verified by getting a signature from the employer or the CPA or a third party that could verify the 3 years moving forward. But that's really an impossible thing for anybody to verify the future. So thank goodness the rule that we get to use moving forward does not include the requirement of the verification by signing a form stating this. So we only, as an underwriter, based on the tools we have to verify that the income is expected to be consistent as well as the assets. It's what we already do. The other part that I think you're going to enjoy is we have to pay attention to the current employment status. Are they self-employed? Are they part-time? Are they full-time? These are questions that we should always be asking, and we already do. It's right on the 1003. We go a little bit further, and we've got to take a look at the monthly payment that the borrower must pay. If I go a bit deeper, I can see that I can't only just stop at that loan. I've also got to take a look at any other second loans or third loans or any other type of loans that are going to come at the same time as it relates to our loan. We now must verify and certify that we're looking at all of that as an underwriting as it relates to ability to repay. And then, of course, we also have to look at mortgage-related expenses, right? Taxes, insurance, MI if it exists. So everything other than just PI will have to be reviewed. And then we've got to take a look at debt obligations, alimony, child support. All of this needs to be reviewed as it relates to the ability to repay. And then, of course, we've got to look at the borrower's monthly debt-to-income ratio or the residual income. And then the big tough one on this, the real big game changer, is we've got to look at the borrower's credit history. As you see, there is no game changer. All of the things that are now placed into law are now ways that we're already underwriting business. Except now we actually receive a certification and a protection for doing the business we're already doing today, but starting in January on the 10th and moving forward, we now get certifications and protections. And that's going to be a fantastic benefit for all of us. Now, let's go in here and let's talk about the other restriction that lives in the loan. We've talked about loan features. We now look at the ability to repay underwriting guidelines and the 8 steps required on all loans. The next one is going to talk about the fees and points paid for achieving a loan. I think that many of us in the industry, and specifically on my side of the fence as a broker, this was a very sensitive area for us. The original version that I saw, and I don't even know if that was the original, let me say the version of the QM rule that I saw at the earlier stages of this year appeared as if the broker industry was about ready to be shut down, depending on the type of business you represent within it. For those loan amounts in the past, we had that 3% cap, but it was including a whole bunch of fees. Even the money that I, as a broker, would pay my loan officer was originally counted in that 3% rule. It became very quick to hit that cap when I included escrow fees, title fees, everything that related to doing a loan, escrow impounds. All of these at the earlier stages were all part of this 3% cap. So here's some moments to get re-excited again. Our broker world is going to continue to thrive moving forward. And what's so incredible is that not only, as we saw earlier this year, it appeared that we were going to be pushed aside, instead it now with the new QM rule and the way it's designed, we're brought right up to the front table and we're supported on a federal level. And let me share with you what I mean specifically as it relates to the new version of the 3% cap as it relates to points and fees. So first, the 3% cap applies to your total loan amount. And we are allowed to include up to 2 additional bona fide discount points, and this is going to depend on the rate, but for most loans we will allow up to 2 additional bona fide discounts, and that the caps for loan amounts which are below $100,000, so for those of the clients and brokers out there that serve communities and neighborhoods with loan amounts less than $100,000, they were protected as well. And I'll go into their protection in just a moment. But their caps are shaped a little bit differently. So what I'm in love with is that not only did we have the ears of both Congress, but we had CFPB willing to listen and understand how these new rules were affecting our industry and directly affecting access to consumer choice. And they listened. So let's take a look. Let's go a little bit deeper and let's just take a pause before I do, because I spoke about bona fide discount points. And this that I have on your screen right now is how the CFPB is defining this. But basically a bona fide discount point is going to buy down the rate, and it's going to be consistent within the industry. It's very general in its term, but it's just something to be aware because it's been defined. But let's get into the part that really specifically talks about these loan amounts that are less than $100,000, because these points and fees are uniquely different for these loans. So, for loan amounts that are between $60,000 up to $100,000, your cap is actually $3,000. So you can earn up to $3,000 for servicing that loan as a broker. For loan amounts between $20,000 and $60,000, the cap has been increased to 5% of the loan amount. And then it even gets smaller. So your $12,500 to $20,000 gets $1,000. So your 8% speaks to loans below $12,500. So I know a lot of us on this call today are in all different zip codes, and we service all different markets. And what I really wanted to highlight for you is, regardless of the market we play in, the 3% caps and fees are going to be okay. Here's what they look like for the loan amounts below $100,000. Now, let's together go and now talk about what's included in the 3% cap, because here's the part that's really wonderful. Broker compensation. So the amount I make as a broker is now part of the cap, whether it's lender paid or borrower paid. Non-refundable mortgage insurances will be included in this cap. I have a funny feeling we're not going to see very many non-refundable, if any at all, being offered next year as it relates to MI. The wholesale lender's fee, your admin fee, becomes part of the 3% cap. And this is interesting. Some brokerages not only own their mortgage practice, but they also have ownership interest in affiliate companies such as title and escrow companies. For those companies which have affiliations, the retained profit is the amount that will be part of this 3% cap. So let's say, for example, that your mortgage company also owns an interest in a title company. And let's say that the transaction, of course, required the title insurance, so the premium was paid, but there was excess profit left over after the company's paid out the cost to do that transaction. It's that part, that retained profit, that gets counted towards this 3%, not the entire fee itself. So as a title insurance company, they're going to offer the coverage and offer the protection, but they have to go out and actually pay for the policy. So the amount that the company actually paid to receive the services is excluded, and only the part that the company actually retained as their profit will be measured. So I want you to be aware that moving forward, under the 3% cap rule, if we want to try to keep it in the more general sense and flavor, it's this simple. So now we really need to take a look at what loan amounts are going to trigger the QM 3% cap. Because now we know what gets to be included in this cap, and it is not the escrow fee. It is not the title fee, the appraisal fee, the impound escrow amount. It is not the amount that I as a broker pay to my loan officer. It is simply the amount the brokerage receives and the wholesale lender charges. So the things that live in your block 1 are areas that are going to come up here in your 3% cap. So let's take a look. And what I'd like to take a look at with you are going to be 2 examples of lender-paid compensation agreement plans between the broker and the lender on the lender-paid compensation as it relates to the 3% loan cap for loan amounts at $100,000 and up. And where I'd like to start first is to take a look at your brokers that are with a 2% lender-paid comp and how they're going to be affected by this change. So let's have fun with this. First, loan amounts at $70,000. Your allowable fee, if you'll remember for me, was $3,000. The lender-paid compensation at a 2% agreement is $1,400. The lender fee, we're going to use $775. For most of us on this call today, that fee is familiar for us. So let's use that for our examples today. And let's say that the wholesale lender administrative fee for all loans processed is going to be $775. And let's also include in our scenarios that the mortgage brokerage that did this loan also owns that affiliation relationship. And so with that said, let's say that they're going to make profit of about $175 on these transactions in our example. So in our first scenario here, we see that I still have $650 left over that still allow me a pad to qualify for my QM. So a loan amount at $70,000, earning $1,400 at a 2% comp is a QM approved loan. In fact, that same behavior shows up at 110. I've noticed, and you're going to see when we go over to the next screen, I've noticed that the soft spot, the sensitive areas to really look out for are your loan amounts between 110 and 135. Those are going to be your sensitive areas, just to be aware of, depending on where your lender-paid comp plan is. But you can see here, no matter what your loan size is, at a 2% cap, when we look at the bottom line, all of these are QM approved. In fact, when I go up to my higher loan size, 275, I've got a lender comp at 2%, I'm at 5,500. Look at how much I still have remaining. I have $1,800 not paid to anybody that's still remaining as a pad that allows this loan to be serviced on a 2% lender paid on every loan that I use today. Moving forward tomorrow, under the 3% cap rule, those brokers at a 2% payout are going to do fantastic. I don't see anything getting in their way of business on January 10th. But I've got a funny feeling that not everybody on this call working with brokers and lenders at a 2% cap. We know that some have even higher caps. So I wanted to take a look at what would happen at a 2.25 lender paid compensation as it relates to the QM rule. And what you're going to notice is that it starts to get a little bit more sensitive as it starts reaching the triggers at 2.25. So let's take a look at this. On our screen at the $70,000, we're still doing fantastic. In fact, I've got $475 left over. But you're going to see under my remaining 3%, look at my two grids right there. My loan amount of $110 and $140, I only have $100 remaining on the $140. And the one on $110,000, you can see your lender paid comp at 2.25 is highlighted in red. That one appears to really be less than $100 of padding, which may trigger this not to become QM approved. So as I shared with you earlier, there is a sweet spot to be sensitive to as it relates to lender paid compensation in the loan sizes that the brokerages are primarily servicing. However, even at a 2.25% lender paid comp plan, what you see at the very bottom of this is that all of your loan amounts are still approved. And if you'll remember for me, I included a title and AMC relationship in there, and I even included a $175 fee. For most brokers, that won't be part of it. So you could even, for most of the people that we work with, add that back in there. And when I do that, then I'm above $100 padding on all of my examples. And that's at a 2.25 lender paid compensation. So I would love to invite you, as you look at your own pipeline of brokers that you work with, and as you work with them to get them prepared for next year and to be ready for the QM, is to look at if we have any of these brokers that are a 2.5 comp plan and higher. So 2.5 and higher are really going to be sensitive payment caps. You can already see what happens at 2.25 on your lower loan sizes of 110. And of course, you can also notice the higher loan amounts we go, the more padding we receive. So the more variance and the less sensitivity I need to be concerned with on my 3% cap rule. Now, before I go back into the other slide, I want to share something with you because this slide doesn't have it on here because it's freshly updated, and I mean very freshly updated by the CFPB last week. And that relates to the fee, your lender administrative fee. Let's take a look at your loan size of 110 here. And let's say that this particular brokerage office was working at a 2.5% comp, not the 2.25. And let's say that they did have an affiliation, and let's say that everything blending together triggered that loan because of the lender cap being at the level it was, and that unique loan that they were trying to do for their borrower. It wasn't their mainstay of business. It was a unique loan that just happened to trigger a QM concern. The CFPB has announced that it will allow, and we already know moving forward next year, because of our works with not only the CFPB but with Congress, and allowing brokers to now participate in offsetting closing costs for borrowers. We know currently that the brokers that we work with are not able to pay for these type of things for their consumers, such as rate lock extensions, These are things that the borrower or lender must pay for, but the broker cannot participate in. However, next year that changes. And next year, for very specific reasons, if something shows up later in the transaction that triggers it to fall out, a broker can now pay to offset to make those corrections. And that also includes paying the lender admin fee to make that loan become QM approvable. So the broker can now, moving forward next year, not today, this takes place next year, the broker, if they trigger a QM, can allow their broker-paid compensation to offset the trigger itself to allow that loan to be QM approvable. So as I shared with you earlier, the version of QM that we get to talk about is fantastic. It's a world of possibilities and a world of certifications and a world that ensures the market has protections that weren't there before. And it allows us as a broker industry to be really supported on a federal level. It's the federal government saying that we matter. We matter so much that we're going to design laws and rules which will allow you to operate in your business working with your investors and your consumers. So for these reasons, I absolutely love the new qualified mortgage rule and its goal in opening up the free market and private equity markets back into secondary. Now, let's go a little bit deeper because so far we've talked about the loans as they relate to QM. But as we know, and what we're already guessing, most loans will not all loans will fit under the QM rule. So the CFPB has made very aware of this because we as an industry have made sure that we had our voice heard and they listened. So because of this, they have made a secondary temporary category. This is a 7-year window of time. It is a temporary window. And for those to fall under this second category of a QM rule, you must be a government-sponsored entity owned under the federal conservatorship. So your Fannie Mae and your Freddie Mac, as long as they're owned by the federal government. The moment those things unwind and are no longer part of the federal government, this temporary protection is removed. Your USDA, your urban developments, your VA, these are all loans that will be part of this 7-year carve-out. Your FHA, your Ginnie Mae stuff, these are all protected under a temporary carve-out. We'll get into that in just a moment. And then for those of you on today's call that service and speak to rural areas, there's even a secondary protection for those smaller markets. And these are certain mortgages that will have a balloon payment in a rural area. This is the only time that a balloon payment has an opportunity to fall under a qualified mortgage under this temporary category. However, to be able to include a balloon payment, the terms have to be at least 5 years, the rate has to be fixed, and that lender has to originate at least 50% of its first lien business in counties that are rural or underserved and must have less than $2 billion in assets and does not originate more than 500 loans per year. So it's very, very specific on who gets that carve-out. And these people that get that carve-out are not subject to the 43% requirement. And let's go a little bit deeper, because on May 6th, the federal FHFA came out and talked about what loans will be allowed to be purchased and not purchased by Fannie Mae and Freddie Mac, and we know that they may only purchase a qualified mortgage. So moving forward, all of our Fannie and Freddie products will be qualified mortgages. But the great news is, and this is the area that stands out so highly for me as a broker, and I think for most of us on this call, is it wasn't the 3% that was concerning me too much. Instead, it was the 43% back-end debt-to-income ratio that I was most concerned with. A lot of us on this call are in different areas, but I'm in California. And in California, a lot of our community are self-employed borrowers. Self-employed borrowers have the ability to write off different taxes and different things within their tax returns that a W-2 employee does not have access to. So the borrower in a self-employed position has a stronger opportunity for showing less approvable income than a W-2 employee might be able to, simply because of the tax code the two get to utilize. So thank goodness that as long as Fannie Mae, Freddie Mac are owned by the federal government, the 43% back-end ratio is out the door. If you receive a DULP approval, that loan qualifies as qualified mortgage. So there is a temporary 7-year carve-out, or unless Fannie Mae and Freddie Mac decide to adjust their guidelines on their qualified mortgage rule. So until one of those moments happen, you guys, tomorrow's business is just as it is today. However, not exactly. Remember, I shared with you earlier in today's presentation that there were specific loan features that no longer get to exist under the QM following. This slide, and my biggest excitement, is that it's not going to relate to that 43% back end. Where you're going to find that being your largest concern moving forward in the first, second, third quarter of next year are going to be your jumbo loans. And as we know, we thought we had FHA to take care of those loan amounts above 625 but lower than 720, and we now know that the FHA is reducing their insurability amount to 6.25. So for all of your loans, 625 and up, that don't get the protection or the opportunity to play with any of the federal agencies, those folks do not receive any carve-out whatsoever. And if any of those lenders are going to underwrite and want to receive the protection which lives within a qualified mortgage, they must absolutely adhere to your 43% back end. So that's where you're going to see your 43% back end show up next year. Those are the folks that are going to feel it first. It's going to be your jumbo borrowers. So as you're working with your brokers and everybody in the marketplace, the area that I'm going to spend my focus with and my referral partners is really alerting them of this change and really maybe determining what type of tax deductions they want to make as they complete their returns moving forward, if there's the hope or intention of buying real estate that year or even refinancing their current home. It's something new to think about that a consumer never had to think about in the past. And why I like it as a broker, it invites me to have a different type of visit with my referral partners. In fact, it even gives me a reason to pick up the telephone or to go into one of their offices just to empower them with something that they didn't know, and it's going to affect them and all of the clients that they represent moving forward. And I've noticed that the more that I do that, the more that these referral partners are looking upon me as the expert and the only source to receive their mortgage loans. Another reason to fall in love with the QM rule. Let's talk a little bit about some of the changes that just happened on November 16th. I know most of you are familiar with these as you service our industry, but these are the rules as it relates to DU, and we know that they've already removed the interest-only feature. That's gone. Loans with prepay or terms greater than 30 years, those are gone. We now know that qualifying for rates on either a 7 or a 10-year ARM, we're going to use greater of the note or the fully indexed rate. And we also know that the ability to repay requirement, that was those 8 levels that we spoke about earlier. Remember, there were 8 specific things that relate to the ability to repay that every loan must be adhered to. Every loan must verify that it did these 8 steps because the reps and warrants live with the life of the loan. So this is a big one for most of us. That's why all loans moving forward will make sure that they go through the ability to repay, because if there are any violations, there will be no protection whatsoever. So that's just something to be aware of, is that every loan moving forward, I doubt we're going to see too many NINAs, no docs, stated. I think that world's gone. It's been gone for a while. With these new tools coming in place, I don't see it resurfacing in the same way we've ever seen it before. And if it does, I don't know what it will look like. But be aware that this restriction lives on the life of the loan for any lender that offers a loan to a consumer. Fannie Mae's capping their loan to values at 95%. Our 97% program is gone. We also know that if MI is financed, 95% is still the cap. You can't go higher. It's not like FHA where I can add that in the background. And some of your HFA products and your Refi Plus, those guys will be able to go over 95% moving forward. So as we start to really digest the final version of QM, my goodness, it's not so bad. The new version of QM really creates a new platform, doesn't it? A new stage for all of us as industry members to step onto and say, hey world, hey consumer, hey mortgage broker, mortgage consumer borrower, here's a loan that is now going to get offered to you, and you're going to receive protections and certifications on a federal level that has met and gone through all of these different tests that it must go through before it's actually delivered to the consumer as a final loan, and that the consumer that actually receives one of these qualified mortgages can trust that they've received a loan which is certified and is trusting. And that's something that we need on a consumer level. We need everybody to believe in banking again. And with these type of tools as law, it really helps us as an industry to look like we're ready to be available for a private secondary market again. And with that said, this has been my presentation and overview and interpretation on the QM. And I shared earlier, and I asked everybody to raise their hand of who thought that the QM had value and they were looking forward to it. And please, based on our visit that we just had now, I'd like to re-invite that same question, and I'd love to ask by a show of hands, how many people with this new interpretation of QM feel like they're going to benefit and they like and enjoy learning what it is? Who here, by a show of hands, thinks that the QM is going to benefit and be of value and we're excited to get it? I'd love to just see if you could please just push that button for me and let me know your thoughts after I've shared this with you. Here's the hands. Deb, Eric, fantastic. Jeff, John, Julie, Michelle. Isn't that super? I love it. If you have a question, you'll find I have a very open door policy. I'm going to give you my phone number in a very easy way to remember. You might not even have to write it down. But here in Los Angeles, we have several zip area codes. One of them is 818, a very easy number to remember. 818. And then my phone number is 20-SCOTT, 20-SCOTT, 818-20-SCOTT. You'll be able to get me directly with that phone number. So if you'd like to reach out and visit on the phone, or if you have a question, my email is scott@scottgriffin.com. And that's Griffin with an I, Griffin.com.